Welcome to part 2 of this interview. I'm going to go ahead and have Linda talk about the 3 most overlooked tax deductions. So that's our next phase. And these are the ones I love, these 3, because again, as Linda talks about, she's got her magic wand out now. This is really important that you realize so many accountants don't know this. And it's beautiful because Linda actually does continuing education for a real estate agent. She also teaches other accountants. She has firsthand knowledge on how many accountants do not know of these most overlooked tax deductions, and they've been around for a very long time. So with all due respect, there's no excuse for not knowing these and you not taking advantage of them, because they actually do really result in money in your pocket.
Welcome to the Jennifer J. Hammond Podcast. Jennifer is a licensed realtor, educator, speaker, and best-selling author. Jennifer's goal is to help you find your yay in every day.
I'm going to go ahead and have Linda talk about the 3 most overlooked tax deductions. So that's our next phase. And these are the ones I love, these 3, because again, as Linda talks about, she's got her magic wand out now. This is really important that you realize so many accountants don't know this. And it's beautiful because Linda actually does continuing education for a real estate agent. She also teaches other accountants. She has firsthand knowledge on how many accountants do not know of these most overlooked tax deductions, and they've been around for a very long time. So with all due respect, there's no excuse for not knowing these and you not taking advantage of them, because they actually do really result in money in your pocket. So Linda, what are the 3 most overlooked tax deductions?
Okay, well, first we'll start. These aren't in any particular order. I'm just giving them to you in the order that they're on the tax return, because that's how I remember everything. The first one is claiming an office in your home. You know, in 1999, Congress completely changed the law. Before 1999, it was almost an automatic audit if you claimed office and home, because under the old law, you had to have a separate entrance for your clients to use. You had to see clients at your home office 5 days a week. You know, maybe you ran a dental office out of your office or something. So that was different. But now what's happened is, since 1999, the only requirement that you need to fulfill for claiming an office in your home is you need to have a space in your home that you use regularly and exclusively. It doesn't need to be a separate room. You don't even need to own your own home. You can be a renter. You could even be renting from your parents or somebody else. But in any case, if you have a space in your home that's used regularly and exclusively, and by exclusively, I don't mean using the dining room, except that once or twice a year you have Easter dinner or a Passover dinner or something there. This has to be a room that nobody else uses. Your children don't play computer games in it or anything else. So if you have such a space, measure the space, measure the whole entire amount of the home, figure out your business percentage. For our realtors and most self-employed people, it's somewhere between 6 and 10% of their home. And I know that doesn't sound like a lot, but here's what it means. Because business expenses, since they save you for taxes, if you can take 6 to 10% of your home mortgage and move it from the personal part of your return over to the business part, you just save double taxes on that amount. Also, the real estate taxes on your home. And when you have a home office, you also get to deduct 6 to 10% of your utilities and your condo fees, HOA dues, repairs, everything that it takes to keep your home running, okay? Now, when you go to sell the house, you do not pay any tax on the gain when you sell the house like you used to do under the old law. And not only does claiming an office and home give you all those wonderful business deductions, and business is the important part, is that it also allows you to claim more car expenses. When I do the shows with Jennifer, I would get up on a Saturday morning and I go to get the donuts or the muffins, and then drive from my house in Bethesda, Maryland, down to Eckington Place Northeast. Okay, that trip was deductible because I was leaving from my home office to go to Jennifer's workplace, which is Sirius Radio. And then I would drive back from Eckington Place Northeast to Bethesda, Maryland. All deductible because I had a home office. If I didn't claim a home office, then that entire round trip wouldn't have been the least bit deductible because it's considered commuting. Commuting is when you leave your home to go to work. So those are never deductible. So if you have an office in your home, not only do you get the extra office and home space, you also get all of your car expenses for those extra trips. So if you're a realtor or an insurance sales or a doctor, a lawyer, whatever, and you don't have an office in your home, then don't try to tell Internal Revenue that you used your car 80% of the time for business. They're going to say, wait a minute, you can't deduct commuting expense, therefore 80% of your car expense can't be deductible. You will get audited. So in the old days, you got audited for claiming office and home, but after 1999, that's when the law changed. I helped get that law changed, by the way, thanks to me and some of my clients. Yes, I beat on some of my clients that were congressmen and representatives. I said, you fix this law or else you won't get a refund next year from me. So that's the new law. So that takes care of office and home. So the second most overlooked tax deduction, it's been around since 1955. So don't tell me that your accountant has never heard of it, because that means they haven't read any tax laws since 1955. And this is a law that allows self-employed people or people that have little companies to deduct all of their medical bills as a business expense. Now, normally, can you deduct medical bills? Say no.
No.
No, very good. I love obedient clients. Thank you, Jennifer. What happens is if you have only personal medical bills, which usually everybody does, they're only deductible to the extent that they exceed 7.5% of your income. So let's say we have a married couple. She makes $50,000, he makes $50,000. So together, their total income is $100,000. Well, 7.5% of that is $7,500. So if that couple happens to have $8,000 worth of unreimbursed medical, such as insurance and glasses and dental and things like that, then how much do they get to deduct? Only the amount that exceeds $7,500. That's less $500. So out of $8,000, they only get to deduct $500. And most people don't spend 7.5% of their income on medical, much less more than 7.5. So all lost. Those are totally undeductible medical expenses. But the minute you become self-employed, you can hire yourself. You say, you know what? I'm head of my own company. I think I'll hire myself. And as the head of my company, I deserve some benefits. Let's see, let's write this down. I should be able to deduct my car. Yep, let's write that down. Oh, I should be able to deduct my medical bills. Yep, that's fine too. So at the end of the year, all of your medical, 100% of what you paid for insurance, glasses, co-pays, long-term care insurance, dental, anything that wasn't covered by insurance is completely deductible as a business expense, which saves you how many taxes? Four
taxes. But Linda,
yes.
Explain a little bit more about that. So what do they need to do to make sure that they have done that properly so that they can 100% deduct all of their medical expenses?
Yes. Well, if you're single, you'll need to, we will need to make you become a C corporation. And as a C corporation, what will happen is when you receive a medical bill, you just pay it out of the C corporation. So it comes right off the top of your income. If you can do that, whether you're married or single, by the way.
So you can't do that if you just have an LLC, right?
Well, you can have an LLC, but you'll need to elect to be taxed as a C corporation. So yes, you can have both. Now, if you're married, you can also elect, forget the C corporation, forget anything. I'm just self-employed. That's fine. Fine. Then you'll hire your spouse to help you. And this happens very often. I would say that 90% of the time, our ladies who are married, who are involved in real estate, of course, their husband runs around and he ends up pounding signs for the open houses, and he'll end up going back and collecting the signs at the end of the day. And I'm sure she'll send him out to deliver things or to take messages or to send faxes or to
you
deliver
forgot the
something.
Toilet paper for the open house. So you send your husband to the store to go get, hey, I need you to go get toilet paper and get it over here right now.
Yes.
The open house.
My poor first and second husbands, they both had to do all that for me. But in any case, that now you've hired them and you need to give them a little salary, about $300 a month. That's all you have to pay them. And I know they're worth much more than $300 a month. And of course, your spouse can have lots of jobs. I have a client whose spouse is one of the directors at the World Bank, for heaven's sake. But she hires him and we give him $300 a month. And then you can deduct all of the medical expenses. What you do is when you hire the employee, your spouse, you say, I'm going to cover all your medical expense for you and your family. Well, who's their family? Well, your spouse's family happens to be you and your children and anybody who's your dependent. So now all of those completely non-deductible personal medical expenses, we just took them out of the trash can and we've taken them up here. And now they've become fully deductible business expenses. So all those expenses just went from saving you 0 tax, not even 2, they saved you 0. Now they're going to save you 4. That is actually the most overlooked tax deduction for anyone who's self-employed. And it's been around since 1955. You don't know how many times I have new clients who come to see us. And, you know, we have over 3,500 clients, 3,500. And I would say that 100% of all new clients we get, they've never heard of the law, which isn't their fault because it's not their job, but their previous accountant never heard of the law because they don't specialize in self-employed people, okay? So that's the second one. And the third one.
Wait a minute, before you go on to the third one, let's talk about that just a tiny bit more. So, because again, that one, you're talking about literally your eye exams, you're talking about your dentist, you're talking about all of the things that I hate to say every one of us have, but again, usually can't deduct it. And then, right?
Yes. Anything that's unreimbursed. Now, sometimes our realtor ladies, they have a husband, like I said, the one who's the husband at the World Bank. He gets free health insurance at work, but the health insurance doesn't cover everything. There's always co-pays, and usually nothing covers glasses and dental and things like that. So you can deduct all of that, including your trips. I just had a new realtor client who comes in now. I don't actually do returns anymore. My son, Preston, who runs the company, he takes care of them. But I ended up speaking to this lady because she's a friend of a friend, and she has twin boys who are both going to be getting braces. And she was just about to write a $5,000 deposit check to the orthodontist for the braces as a down payment. And we told her, don't write the check. First, we're going to hire your husband and give him a little $300 a month. And then you write the check to the dentist, which will become fully deductible. And she's going to end up spending thousands of dollars for her twin boys. So, oh my gosh, we got her just in time.
Well, and I think that's really important. And so when you set up the $300 a month for the husband, do you need like a bookkeeper who keeps track of that $300 a month, or how do you prove that?
We do it automatically. I think Marty Wapner in my office has set up more of these more of these employee business plans than anybody in the United States of America. My company, I've been doing them now for 40 years. We set up more of these medical reimbursement plans than anybody else. And so we do it for you. I think it's about $800 the first year to set everything up, and maybe $500 a year thereafter. So we handle it all. We handle, paying the paycheck and taking out the taxes, because then you do have to take out a little federal tax and a little bit of Medicare and Social Security tax. It all has to be done properly, just as if you were hiring a stranger. It just happens that this person you hired is your spouse and you love them and you want to give them all of their medical bills as a reimbursement. Aren't you a good boss?
A good boss.
Yes, and the wives, they can take their husbands out to dinner and talk business. They can take their husbands on real estate conventions and talk business, or their partner, whoever it is. My daughter Macarena, she has a wonderful partner, Yvette, and when they go out, and if they're talking business, it's deductible. And if it's at a restaurant, it's 100% deductible.
That's awesome. So, and what about for other family members? I know you said you can hire children. What about hiring a parent or a sibling?
Oh, yes. I had a lady who was a realtor who every month she was paying $800 or so per month for her mother's prescriptions that weren't the part that wasn't covered by insurance because the mother hadn't even reached 65 years old, so she wasn't even on Medicare. And I said, well, does your mother ever help you with work? She says, oh my gosh, my mother makes my schedule, and she takes care of things. And if I'm entertaining, she'll cook all the food and everything. So I said, we need to hire your mother. So we hired the mother, and we put her on her little paycheck for $300 a month. And you know what happened?
What?
Within 6 months, the mother took her job really seriously, and she would go and get her hair done and her nails done. We couldn't deduct that. But the mother lost about 50 pounds, and she didn't need to take the medication anymore because no longer was she diabetic. So it worked out absolutely great because Mom was living with her, and she was a full-time secretary. And Mom was very serious about her job because now she was getting paid to do this. So the $800 that we originally needed per month for the medication disappeared.
Oh.
But when you have an employee, now you can put money away for their retirement. You can give your employee a cell phone, that's deductible. You can reimburse your employee for use of their car. Like many times the employee, the husband or whatever, or the mom is going out and delivering things or pounding signs or whatever. So it's very, very nice. And I had one lady realtor who, the real estate convention was coming up. We have it here in Ocean City from time to time. I always speak there. And she said, well, now that I've hired my husband, does that mean I have to take him to the real estate convention in Ocean City? I said, you can, and he's deductible, but you don't have to. She said, no, I don't want him there. I have more fun without him. So you're the boss and you get to decide. You can give your employee a turkey at Christmas time and deduct it.
And you also mentioned long-term care. So there's life insurance that you can purchase that has long-term care in there. And that is also a tax deduction, but only if you have this medical reimbursement plan.
That's right. If you have the medical reimbursement plan, you can deduct the long-term care for you. If you hire your spouse, you can deduct the long-term care for your spouse. It's all of your family's medical. So even if you haven't hired your spouse, you can still deduct the long-term care for your spouse because that's part of your family and you're the employee. So all of these things, and you can also deduct life insurance on your employee, okay? Things that would never be deductible otherwise without the medical reimbursement plan. And if anybody has any questions on this, if you go on my website and just contact Marty Wapner, he's from New York. You'll love his New York accent. Marty sets up these plans. And like I say, I think it's $800 for the first year and maybe $500 a year thereafter, which includes everything, including the payroll. And that $800, is it deductible? Yes. The $800 is deductible. So you're going to get back $400. So it really only costs you $400 out of pocket. And now you can deduct thousands of dollars in medical bills. What is there not to like about that? Yes.
Exactly. That's why I wanted to continue to keep asking about all the things that are deductible under that. Because as entrepreneurs, I think that people get surprised, just like I was asking that question for my sister earlier. It's amazing how their accountant will say, no, you can't do that. I'm like, well, wait a minute. I think you can. But again, the thing is you didn't do the medical reimbursement plan. You didn't set up the proper tax or whatever structure and legal structures that you need, whether it's an LLC, a C Corp, an S Corp, as we've kind of, gone through this. And I know we're running down to our last couple minutes, and I want to get to the third most overlooked tax deduction. But I also want to say for everybody who's in the room, everyone who's in the audience, if you guys want to raise your hand, feel free to raise your hand. We'll pull you up on stage and you can ask questions as we go through this last little bit with Linda. So Linda, here it is, the most overlooked tax deduction. Dun, 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 dun.
Yes. This is a law that was passed in 2001. So it's not new. Okay. It's been around since 2001. It's called a 401k plan. Now, many of you worked at jobs where you had a 401k, which was very nice because your employer put money in, you put money in, and it was all deductible, and that's wonderful. Well, when you become self-employed, you're your own boss, so nobody's going to take care of you. Do you know that 95% of all Americans who are presently retired today, 95% of them are financially dependent every month with the help of a check from Social Security, Medicare, their church, or their children. Well, when you retire, are you counting on Social Security to help you, or your church, your children, or welfare? No, 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 no. You want to depend on yourself. Okay, so for $160 a year, you can have your own solo 401k. I don't sell them. I don't get a kickback on them. I have nothing to do with 401ks, except that I happen to have one myself, and that's how I know it's $160 a year. Now, you can pay more. You can pay $1,000 a year and have another one, but the one that I use, the one that I like, is $160 a year, and like I say, I don't get any kickback. Now, this solo 401k is a qualified plan. If you have a SEP or an IRA, those are unqualified plans. Would you like to know the difference?
Yes.
Only the qualified plan is 100% protected from lawsuits, creditors, and bankruptcy. Only the solo 401k. Now, you can have a DB plan, but we won't go into that. Now, the other plans are not 100% protected from lawsuits, creditors, and bankruptcy. Number two, with a solo 401k, you can usually put more money into it because you're allowed to put in 20% of your net earnings from real estate, including that Airbnb. And you're also allowed to add an extra about $20,000, 19.5, something like that. Okay, so on 20% plus an extra 20,000, let's say. And best of all, at any time for any reason, you can take loans from your solo 401k and use the money for anything you want. Now, you folks out there that are men, I don't want you going out and using money from your solo 401k to buy a motorcycle or to go, or a boat. Don't do that. No, 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 no. Women would never do that, but men think about it sometimes. Okay. Or you can do like I do, you can borrow money from your solo 401k to buy investment property. When my younger daughter, Macarena, you heard about earlier, my younger daughter, Gia, went to law school up in Baltimore, I bought a little townhouse up in Baltimore back in 2001 for $135,000 with a great real estate broker helped me find it. And she was there for 3 years. She graduated very, very honors, and she was the youngest one in her class and all that. And guess what? When she finished and moved back to Bethesda, I sold it for $210,000. So if I hadn't been able to borrow the down payment from my solo 401k, I would have just paid rent checks for those 3.5 years that she was up in Baltimore. So what happened? I bought it for $135. I sold it for $210. I made a nice profit that covered all of her law school. My son was in law school at the very same time, but he got a full scholarship. Thank you, Preston. That was wonderful. But in any case, you can borrow from your solo 401k. Now, if you want to take the money and go to Las Vegas, or maybe Jennifer and I want to go to Turks and Caicos, where that background is.
Yes.
Or St. Martin, so we can make some perfume together.
Yes.
But in any case, I would advise that if you want to take money out of your solo 401k as a loan, then you can do so, and you can use it at any time for any reason. Now, if you're just taking the money out to buy an investment property or for any other reason, maybe you have to pay some tax bill or maybe credit card bills. I don't like that, but if you had to, you need to pay it back over 5 years, and the interest rate is 5%. But if you borrow the money from your solo 401k to buy your own home, your primary residence where you're going to be sleeping and everything, then you have a 15-year payback at 5% interest. So that's very nice. Now, if you were to take money out of your SEP or your IRA, it's fully taxable. You're going to pay federal tax, state tax, and usually you're under 59.5, you're going to pay a 10% penalty. Yikes. Okay. Whereas if you take money out of your solo 401k, it's a loan. There's no tax to pay, and you continue to pay yourself interest, which goes back into your solo 401k. So you still have the 401k, it's making money, and then your money is working for you at buying a rental property. And you're allowed one, yes, more than yay, fabulous, double yay. So a solo 401k, if you need any questions, I'll refer you to, like I say, I don't sell them, but I use Mark Moninger, and he's my certified financial planner. Do not buy any retirement vehicle of any kind, investment, unless it's from a certified financial planner. Okay, don't trust anybody else. So I'll refer you to mine if you send us an email on our website. but or you can look up Mark Moninger. He's here in Rockville, Maryland. He's done my solo 401k for 20 years, ever since it was invented. And I've sent in hundreds of people.
I was going to say, let's go ahead and tell people your, I just realized I should have pinned to the top of the room. I'll do that in just 1 second. I will pin. Go ahead and tell people your contact information if they wanted to call. And also one of the things, talk a little bit about before we run out of time. I know that you will also do a review of like the past 2 years of someone's tax returns and see, you take out, I love when you actually do this. You take out your red pen and you circle all of the deductions that someone missed and how much money they could have saved. And you do that for free, right?
Yes, I will do it personally for free. After April 15th, as you know, right now it's March 15th in 2022.
Exactly.
But after April 15th, I would be happy to. I would advise everybody to go on extension, because if you haven't gotten all your material together by March 15th, then do it before, you can do it before October 15th. That's all that matters. But if you think that you're going to owe any money on April 15th, go ahead and pay that no matter what. Because if you're going to open up a 401k, you still have time. I forgot to mention, with a 401k, you don't even have to put the money in until October 15th of the following year. So I have many clients right now who made good money last year. Real estate was booming, and they're going to owe money. So we're having them pay at least the federal tax, and then they're hoping to save up more money before October 15th. And then if they put it into their solo 401k, that's going to reduce what they were going to owe. And because it saves them money dollar for dollar. And if you want to reach us, our company name is Tax-Masters, and we're in Rockville, Maryland. And our website has lots of free information. There's free checklists of deductions for your car, your office and home, all the realtor deductions that you folks who are realtors could need, or anybody, business deductions if you're self-employed in any way. And you'll meet our team. There's 20 of us in our office. Everybody in the office is smarter than me, so you don't want me. I just talk and teach about it, but everybody else actually knows how to do it.
Well, and I know, because we all call and say, I want Linda, because I heard Linda on TV or on radio and stuff. But I went ahead and I pinned to the top of the room. I know we only have a couple more minutes before we're going to be out of here, but I pinned to the top of the room, Tax Masters. It's tax-masters.com at the top of there. So you can get her website there, and you can send emails if you want the free review. Remember, after April 15th, because it is the middle of the tax season, it is super busy right now for most tax accountants. And I'm so grateful, Linda, for you being here. I wanted to go ahead and ask John Lee. I know usually you have a great question. I know, John, you know Linda. Do you have any questions for Linda today?
Oh, yeah, thank you, Jennifer. Just a quick one. And thank you for having Linda back. Always great. You always have such great guests, but Linda is always so good hearing from you, and you're so knowledgeable. I've already got a whole page of notes, and it's not even 8 a.m. here, so I want to thank you for that. I just got one quick question. You were talking about meals going up to 100% in 2022. Will that also include entertainment? Because I know I used to group them together, meals and entertainment. That's how I kind of look at it, because I used to have season tickets for baseball and use them for business and things like that. So that's my question. Thank you.
I have bad news for you, John. It used to be we could deduct tickets for entertainment, if you go to shows or you men like to go to sports events. Unfortunately, entertainment is no longer deductible. That one changed a few years ago, but the actual meal is deductible. So let's say you take your friends to a sports event, but while you're there, you buy them some beer and hot dogs and peanuts or whatever you buy at the football game or the whatever game it is. That you can deduct all of the food, assuming that while you were chewing the food, you were talking about business, which I'm sure you were. Then the food would become deductible, but not the actual cost of the tickets. I'm so sorry.
Go ahead, John. Did you have something else? But all the other expense, like other meals and going out for coffee at Starbucks with business people, associates, all of those are going to be the 100% deductible for this year, for 2022, right?
Yes, and we don't know what's happening in the future because anything could happen before December.
Right. It is a very interesting time. Well, I know we're at the 9 o'clock hour here in the Eastern time zone. And I wanted to just check, is there anybody else in the audience who had a question before we go ahead and say goodbye to Linda? or on the panel? Anybody up there? Lily? Oh, go ahead, David. Do you have something?
Question. Yeah, just real quick, the home office deduction, we do that for LLCs. Do you know if you can do the home office deduction when you've created a C corporation?
Okay, what happens with the C corporation is you will reimburse yourself for the percentage of the expenses on your home. So if it's 6% use of your home, then 6% of the utilities and the homeowners association fees and the condo fees and the insurance on the house and the repairs, you'll just reimburse yourself for those. So it is deductible. It just requires a little more bookkeeping. Like all C corporations require more bookkeeping, but of course you're going to hire a bookkeeper to keep track of it, right? Because you don't want to do it. Your time is too valuable.
Exactly.
Right?
Well, thank you, David. That was a great question. And thanks, John. Thanks, Lily, for being here. And thanks, Tom. And thanks, everybody who's in the audience. You guys, let's see, there's Kevin, all you guys. I am so grateful for all of you being here. And again, we'll have this on replay. We'll play it back again. And Linda, you are the tax master for sure. Thank you. Yay. She's throwing up $100 bills. And of course, her magic wand. Yay! We want you to save money, save money. So I'm going to go ahead and as I say, everybody who's up on stage, if you will come off your mic and let's end the room with our yay, our famous yay, and then I will close the room down. So 3, 2, 1. Yay!
Yay, Jennifer! Yay, Jennifer! Love you, darling. Thank you.
Thank you, guys. Thank you, thank you,
Bye-bye.
thank you.
Hi, I'm Jack Canfield. You may know me as the co-author of the Chicken Soup for the Soul series. And if you want more help in getting from where you are to where you want to be, I want to encourage you to listen to the Jennifer Hammond Show